Hi, welcome back. We shall continue on the glossaries. So, we have already looked at the definition of the gross sales, cost of sales, gross profit, and hopefully we can finish all the remaining glossaries for the financial analysis. The next one is operating expenses. So this refers to the expenses used for supporting an organization's operations for a given period, such as salaries of administrative personnel, costs for researching new products such as R&D team, and marketing expenses. The operating expenses are different from cost of sales. This is because the operating expenses cannot be linked directly to the production of the products or services being sold. So the operating expenses are more likely to be general expenses rather than related to the product. The trend of operating expenses, if we've watched to detect signs, both positive and negative signs of managerial efficiency. The next one is operating income. Deducting the operating expenses from the organization's gross profit produces the operating income. So this figure, the operating income, will represent the organization's earnings from its normal operations before any so-called non-operating income and or costs such as interest expenses, taxes, and special items. Income at the operating level, which is viewed as more reliable, is often used by financial analysts rather than net income as a measure of profitability. So you can use the value for the operating income to be the measure of profitability. Then we look at the pre-tax income. Another carefully watched indicator of profitability, earnings garnered before the income tax expense, is an important step in the income statement. Numerous and diverse techniques are available to organizations to avoid and or to minimize taxes. There are tips and tricks to minimize taxes that affect their reported income. Because these actions are not part of the organization's business operation, analysts may choose to use pre-tax income as a more accurate measure of corporate profitability. The second last item is the income tax. I think you should already familiar with individual income tax. The company income tax amount is the amount that has been created to cover what the organization expects to pay to the government. And finally, the net sales. So this is also known as the net income or net earnings and is the bottom line of the income statement. So this is very important. And the net income is the most commonly used indicator of an organization's profitability. If the expenses exceed the net income is actually net loss. Okay, so you can see the value if it is less than the the income is less than the expenses, basically the company are at loss. After the payment of preferred dividends, if any, the net income becomes part of the organization's equity position as retained earnings. That's all for today. We will continue on the following video to look into the cash flow statement. If you have any comments or question, you may leave at the comment in the YouTube link. Thank you and bye-bye for now.